The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A bet on the consumer and an even bigger bet on cyclical stocks. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Alex Steele, and happy small cap day.
Happy small cap day. Outperformance once again. 5 straight days of this, Alex. When does it end?
Does it? I don't know. Let's get a check on that. So you're taking a look at the S&P up 0.6%. Yes, we're at a record. Dow at a record as well, thanks to United Health. But it's the Russell 2000 up over a whopping 3% that's really catching the headlines here, beating the NASDAQ 100 by almost 11 percentage points. We haven't seen that since 2011, and this is over the last 4 trading days. A bit into the bond market, 10-year yield, you're seeing the flattening of the curve now with yields down about 6 basis points, a reversal from what we've seen over the last 4 trading sessions. And gold also grinding its way to a record here. It's kind of a mixed bag, I gotta say. To find the narrative, Romaine, is something we're gonna have to work on over the next couple hours.
Well, when we go back to equities and we look at the price action, that rotation out of large caps into small caps, the boost today, that additional boost really coming from that firming macro backdrop, that retail sales data for June, a surprise. Consumers still have spending power left in the tank, and that strong data really did put a bid under small cap discretionary stocks. It put a bid under materials and other cyclicals, and even put a bid under treasury prices to boot. But the favorable macro backdrop does belie a strange dichotomy out there between short-term investor expectations and longer-term outlooks. The nominal yield curve really indicative of the former, with yesterday's bear steepening. But you look at today and the real yield curve reflective of the latter, with more investors now pricing in tighter financial conditions ahead. That's got to be reconciled. But for right now, though, that may not even matter for investors out there who are reaping windfall stock market returns, and the big banks out there reaping windfall fees. With all of the major U.S. bank earnings now in, we now know equities traders across Wall Street pulled off a clean sweep of higher than expected gains from helping clients bet on stocks last quarter, more than triple the increase analysts estimated. Bank of America's revenue from equities trading, that was up almost 20%. The CEO of Bank of America just spoke with Bloomberg moments ago.
We feel good about it. He made $1.4 billion after tax this quarter, which is a very strong earnings quarter. But what's happening is you're seeing back-to-back billion-dollar-plus quarters.
And so there you have it, Alex. And we talk about this idea of, do I say the 4-letter word, Goldilocks? It seems like everything, at least for right now, seems to be working for everybody.
Yeah, it's small caps world. We're living in it. Something I haven't said probably ever. So the question is, does all of this actually continue to play out? Romaine was talking about the flatter curve that we're seeing in the market versus the steepener. So here's a chart from Simon White. Bear with me on this one. It's a little complicated, but he gets to a really interesting point. So we're going to look at the curve flattening in a different kind of way. So this chart shows the nominal real yield curve. That's 210s. That's the white line. That's what we see here, right? It's really flirting with that positive level. The blue line, though, shows the nominal real yield minus inflation expectations. So taking a look at the UMISH expectations number and backing out that inflation for the 2 and the 10s, and that curve is quite inverted. Now you can see usually they wind up tracking each other, and you can make an argument that the nominal real yield minus expectations is a better forward indicator of where we might wind up. So this inversion raises a lot of questions. Are consumers actually legit worried, and will they pull back their spending? And if they do, does that mean we're looking at sort of a softer economic patch, raises questions about the rally in the equity market, raises questions about the expectation of lower long-term bond yields at the same time, Romaine? Well,
our first guest is raising some of those same questions, in fact, saying that, well, this is not necessarily the time to put on risk, even if you do stay invested, particularly in the fixed income space. Stephanie Larosiliere joining us right now to help kick us off to the close, head of fixed income business strategy and development over at Invesco. And Stephanie, let's start there here, because when you look at financial conditions, I don't know, I guess it depends on what side of the fence you're on right now. You can look at things and say financial conditions are certainly easy. The money's there. There are some people, though, they see tight conditions now and even tighter conditions up ahead.
Yeah, so the way that, we see it at this point, we do believe that we're in for a soft landing, right? So we do think that you do need to be prudent in terms of putting risk on. But I think finally, after, about a year of preparing for the Fed to cut interest rates, we're finally at a point where we feel confidently that the Fed will cut rates. And it might be time to start to look out on the curve, and maybe duration risk is where you want to go as opposed to credit risk at this point.
Do you wait to do that, Stephanie, until either we get that first cut or at least a little bit more of a definitive statement that that first cut is coming, or do you try to position around it now?
We really think you try to position around it. We think that you start to leg into that trade. Typically, when we look at, right now there's still $6 trillion in money market funds. Typically, the individual investor stays in money funds and stays in cash much too long. So you want to start to leg out on that trade. You want to start looking at the ultra short funds in the space, because that 5+% on the money markets is not going to last.
Yeah, people keep telling me that, Stephanie, and I keep not listening. But, it's a fair point. I want to get to the long end part of the equation, because it does feel like higher yields may actually be here for longer on the back end, even if the front end winds up coming down, particularly if we get a President Trump in the White House and we get something like weaker growth and higher inflation.
Yeah, we certainly, have a thought process that is in line with what we're thinking here. We do think that we're likely to see some steepening on the curve, which, again, we've been waiting for quite some time. So it'll pay off to be longer on the curve at some point. And we do agree that with, the political backdrop that we have now, we're likely to see the longer end kind of stay anchored to where it is while the front end comes down.
Okay, so you see the 10-year not coming down, just not going up either.
Well, we see it coming down marginally. I would say we're looking, when I say, kind of staying anchored, we're looking further out in the curve. So we look at the 30-year, we're likely to see that kind of stick around where it is right now, with the 10-year coming down marginally.
So, Stephanie, as we sort of push ahead, I do have to ask you a little bit about election risk, particularly for those folks who are counting on rate cuts and rate cuts this year that would require even greater repositioning, greater rotation than what we've already seen, not just in fixed income, but across all the major asset classes. Are you worried at all about that maybe running into, complications, if you will, from how the election shakes out in November?
That's a great question. Right now, I think, what we do know is that President Trump is the nominee for the Republican, ticket, and that was no surprise. I think the market is really pricing in a lot of what we're expecting from a political backdrop. So, right now it's just my crystal ball is a little unclear when it comes to the political side of things. There's just so much that can happen between now and November.
All right. Well, a very measured response to that question, as we expect out of you, Stephanie. Great stuff. Stephanie Larosiliere, head of fixed income business strategy and development at Invesco. As we count you down to the closing bells, coming up, a closer look at Amazon Prime Day. The numbers are already starting to come in. The preliminary numbers showing that folks are spending, and quite a bit relative to last year. We're going to talk to the executive who's actually behind getting you that package in the very last mile.
Did you buy?
I did not.
You did not yet. All right, plus you got Starboard and Match Group in a showdown over the best path forward for online dating company. We're going to get into the activist investors list of demands.
And as we talk about all the consumer spending being resilient here, a little bit of a gut check. Car repossessions skyrocketed earlier this year as high interest rates and inflation really did put the squeeze on household budgets. You really want to see what these numbers show, and we're going to have a discussion as to whether there's any relief anytime soon. All that and more coming up in a bit. This is The Close on Bloomberg.
If you look across the board, it's solid, growing a bit, but growing consistent with the lower growth, 2% type growth, lower inflation economy. It's not growing as fast as it was coming. The pandemic shot up, went down, and it started growing faster. Same with deposits, went up, drained down, they're stable. The activity is kind of normalizing.
That was Bank of America CEO Brian Moynihan speaking with Bloomberg just moments ago after delivering a very strong quarter alongside Morgan Stanley and PNC. Results setting the stocks higher. Morgan Stanley at 1 point hitting a record. Bank of America at a 2-year high. Joining us now is Erika Najarian, Managing Director for Large Cap Banks and Consumer Finance over at UBS Investment Research. Hey, Erika, let's just drill down to Bank of America. Was this number worth a 2-year high on the stock?
In a way it is, because it's really not about the number that they reported today, but it's about the path forward. So Bank of America essentially laid out a path for a fourth quarter net interest income number. That's their interest margin times how big their balance sheet is. It is substantially larger than what they reported in the second quarter. And of course, they gave us a lot of moving pieces in which to conclude that number will continue to improve from that fourth quarter exit rate. And so what the market is really buying into is not the result of the quarter, but the promise of higher consensus revisions for 2025 outlook.
The question, though, becomes, isn't that all dependent on Fed rate cuts, particularly their net interest income? Like, they didn't say it had, like, it's not going to trough now or third quarter. Like, it's going to get better in the fourth quarter, which leaves question marks around the third quarter. What do we get in the fourth quarter? We get rate cuts.
So that's a really good question, and here's how I would frame it. So B of A perhaps didn't manage the interest rate cycle on the way up as well as we had hoped. And so they put on a lot of, let's call it underwater derivatives, extended duration, bought securities at very low rates that couldn't reprice as quickly. And so, clearly that's not a good thing when rates are going up. Some of those instruments or investments are now maturing. And so there is a clearer rate path for B of A, even though, of course, as you mentioned, we're now going to get rate cuts, because that financial engineering that didn't quite work out is maturing and maturing at higher rates, replaceable at higher rates. And then B of A can get the benefit of when the Fed starts cutting, they can cut their deposit costs. So net, this is why the stock is up 5% on the day.
I am curious, Erika, if we could kind of turn our attention to PNC on the same topic, particularly with some of the net interest income and the idea that the complexion of what helped PNC beat was a little bit different than for Bank of America. We should also point out that this is kind of a return to actual positive NII for PNC after something like 2 years of not having any here. What is driving that, and why aren't we seeing that, and are we going to see that in some of the other regional banks as they start to report?
So slightly different, but a little bit of the similar theme. So what is really striking about PNC is that deposit costs only went up by 1 measly basis point this quarter. And so that is a pretty significant outperformance. And they restructured the balance sheet. And additionally, they have some of the same financial instruments that are underwater in a higher rate environment that will roll off over the next, let's call it 12 to 18 months. So there's some mix of, what B of A is, calling out that's relevant to PNC as well. As for the read across with other regionals, I'm not necessarily that excited to just, read through the fundamentals, because what PNC has that other regional banks don't have as much is capital. They were able to restructure their balance sheet because of that capital. When loan growth comes back, they expect to outperform the regional banks. And so while the deposit cost dynamic in terms of stabilization may be a good read across, I'm not sure if the ability to optimize the balance sheet truly is.
Well, let's go look at some of the more pure play regionals. Obviously, PNC is kind of a super regional, if you will, kind of enough on its own. We're going to get some of those more pure play regionals. And of course, we're about a year and a half removed from that so-called regional banking crisis of about a year ago. What has changed since then? And are we going to see meaningful improvement and, more importantly, meaningful solidification of those balance sheets?
So I think there's a difference between the fundamental path from here and what the equities market might start thinking about. Going back to your earlier question on the election, on one hand, I think that with loan growth so soft, and you heard that from Brian Moynihan, you heard that from PNC, the pure play regional banks are way more sensitive to a lack of loan growth in terms of their EPS output for the rest of the year. That being said, I think that we meaning the market, are starting to really price in the probability of a Trump victory. And the regional banks have massively underperformed the money centers year to date. And so as we think about the market's favorite themes as it relates to banking that they tie to a Trump victory, it's the trifecta of rates, lower rates, deregulation, and consolidation. Even though the fundamentals aren't recovering as quickly, the multiples may.
All right, Erika, thanks a lot. We really appreciate it. Thank you, Erika Najarian. I know it's a very busy day. I'm Managing Director for Large Cap Banks and Consumer Finance over at UBS Investment Management. Where we got some breaking news here. Elon Musk saying that SpaceX will now move its headquarters from California to Texas. In some ways, not a terrible surprise, but again, moving the headquarters from California to Texas.
Yeah, course, Elon Musk right now just putting out a post on X complaining about a new law, whether that was the impetus for this or not. Of course, we know they officially at least got the authorization to reincorporate Tesla. I believe that was last month in June to Texas, although we should point out Tesla's basically had its physical headquarters down in Austin for years now. But a formal incorporation of Tesla down there, maybe the move now of SpaceX here. I don't know. What's next?
I don't know. Does he move there? Where does Musk live?
Who knows?
You know?
I think he's
Somewhere?
I think he lives on his private jet as he circles the globe. But we should point out Musk is citing California's transgender notification law as a reason for the move. All right. Well, we'll try to get you some more details on that. Of course, as one of the world's richest people here continues to air out his grievances and find a more hospitable place for his businesses down in Texas. We are going to focus a little bit more, though, on the 2024 general election, which is apparently showing up to be a lose-lose situation for discount retailer Dollar Tree. At least that's the opinion of our next guest. That's coming up after the break on our Top Call segment right here on The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, the big movers on the back of analyst recommendations. And we start today with Chegg, Morgan Stanley, giving the education platform a passing upgrade for now with an upgrade to equal weight. The analyst citing the outlook for solid free cash flow generation and says the shares have already priced in all foreseeable headwinds. Shares of Chegg having their best day going back to November. Next up, Starbucks, Evercore downgrades to inline. The analyst surprised by the lack of movement in revenue despite new products, as well as warmer than usual weather that should have benefited cold beverage sales. He's also worried about weakening consumer demand over there in China, lowering his price target to 80 from 92. The shares, though, bucking that trend up 3% on the day. And finally, let's take a look at Dollar Tree. A cut from overweight down to neutral. This over at Piper Sandler, with the analysts flagging overly ambitious earnings estimates and risk from government policies. He says Dollar Tree is uniquely disadvantaged regardless of who wins the 2024 presidential election here in the U.S., as both candidates have policies that could set profits back for the company. Shares of Dollar Tree relatively unchanged on the day, higher by about 0.1%. Those are our top calls, but we do want to stick on Dollar Tree for just a second and bring in the analyst behind that call, Peter Keith, Managing Director covering hardlines and leisure over at Piper Sandler. All right, let's kind of unpack here some of these unique disadvantages, Peter, particularly when it comes to the political landscape. And we're going to start with the obvious one, and that is tariffs. Obviously, a company that sources a lot of its products from China.
Yeah, so with Dollar Tree, you have to remember that's two different banners. You have the core Dollar Tree banner, and then you also have the Family Dollar banner. Both of them do source from China. It's that core Dollar Tree banner where it's a disproportionate amount of sourcing from China. About 40% of their sales source from China. And where we think core Dollar Tree is uniquely disadvantaged is that they still have a majority of the store as a fixed price model where everything is priced at $1.25. So a lot of companies, as they're working through tariffs, might be able to take some price increases. Dollar Tree would not be able to do that immediately with their model. They could certainly maybe go to $1.50, but something that would be a larger strategic shift for the company.
There's been a lot of talk here just about Dollar Tree overall. I mean, sort of absent of whatever happens in this presidential election cycle. The idea that this was a company really trying to find a better business model, whether it's shedding certain assets or at least spinning them off to give them a little bit more clearance. How much progress have they made on that front, and are you happy with it?
Yeah, they've been giving it their best shot. We've been disappointed so far. We did upgrade this stock over 2 years ago. It was March of 2022, and it was when there were some activists involved, and they brought in an executive named Rick Dreiling to run the business. Rick Dreiling had a lot of success turning around a competitor named Dollar General, and so we think he was, very well suited for this role to try to drive a turnaround at both Dollar Tree and Family Dollar. Rick was able to bring in a lot of his own team, and the board was replaced. So all the pieces were in place for what we thought would be a great turnaround. But it's been over 2 years, and where we sit today is they're now looking at strategic alternatives for that Family Dollar banner because the sales have been disappointing. And even on the core Dollar Tree banner, they've tried to push towards slightly more multi-price model. The same-store sales are still kind of in that low single-digit range, so still a bit sluggish from where I thought they should be. So 2 years in, it just feels like a turnaround that's, kind of been disappointing. And at this time, you really should be seeing better green shoots.
Peter, it's interesting. You gave a neutral rating, and the stock is pretty much flat. And I'm wondering if we're at the lowest price that we've seen in like over 2.5 years. If for now we've just found a bottom at like 103 or 104, what do you think?
Sure. I mean, the stock, as of last night, was down 27% year to date. So it's not like I'm early on this call. But, we just felt like there's so much earnings risk as we look out to 25 and 26 when you think about either tariffs under a Trump administration or this overtime rule change under a Biden administration. So stock's flat today. I would say, most of my universe, a lot of retail is up nicely today because of the retail sales. So, maybe a little self-serving, I'd still point out, even at flat, that Dollar Tree is underperforming the broader tape today.
Oh, yeah. Well, and also, like I said, I mean, it's at the lowest price we've seen in like over 2.5 years. Peter, I'm wondering what part of this also has to do, irrespective of, say, Trump or Biden, what part of it has to do with the fact that Walmart, Target, other stores can offer super low prices now in a way that they might not have been able to compete with the Dollar Tree dollar stores in general?
Yeah, it's a fabulous question. Because really, when you look at the last 2 years, with all the inflationary pressures on lower income Americans and certainly middle income Americans, it's really an environment where the dollar stores should be thriving and picking up share. People are shopping in smaller baskets, and the dollar stores provide this nice quick stop convenience. You go back to 2008, 2009, 2010, the dollar stores were posting up fabulous sales results. So that hasn't really happened here the last 2 years. And then you look at like a Walmart, where Walmart, is comping 4%. They're putting up great numbers. And so there's certainly, some thought that the market share is being absorbed by other larger players like a Walmart, and less so for the dollar stores today.
All right, Peter, we really appreciate it. Peter Keith over at Piper Sandler on that Dollar Tree call. That stock is just up by about 0.1%. And that will be front and center, particularly, Romaine, as we head further into earnings season at the top line struggling because of the consumer.
Yeah.
Who has the margin power?
Yeah, and it's a good question, but it also raises the question, too, of just how conflicting a lot of the data and the earnings are, right? I mean, one day the consumer is king. The next day it's like apparently they're struggling.
Or they only shop on sale, but not at Dollar Tree. It is confusing. All right, well, coming up, it is a high bar for stocks this earnings season. We're going to get some insight from Melissa Brown, Managing Director of Applied Research at SimCorp. This is The Close on Bloomberg. Let's get back to that breaking news. Elon Musk moving the SpaceX headquarters from California to Texas, citing California's newly passed transgender notification law and other bills that have preceded it. Bloomberg Technology co-host Ed Ludlow jumping on the story for us and joins us now. Hey, Ed, was this expected?
I don't know that it's expected. It's in line with Elon Musk's actions with his other companies, right? So Tesla had its headquarters moved from California to Austin, Texas in 2021, and part of the background of that was Musk's frustration with both local and state lawmakers in California on all manner of things, procedural through to political. AB 1955 was signed into law today by Governor Gavin Newsom. It prohibits teachers at public schools from informing parents of any child's change in status, gender status or sexual orientation. And Musk, responding to another ex-user, basically said that was the final straw for him and for the company. And from a sort of space industry standpoint, it's important to note that quite a lot of SpaceX's activity is in Texas anyway, in Boca Chica, near the border with Mexico, but not all of it. So, it's an interesting development for America's most valuable private company.
All right, there you go. Ed Ludlow, the co-host of Bloomberg Technology. A read here on Elon Musk, a post on X saying that SpaceX will now have its headquarters down in Texas, moving from Hawthorne, California. Elon Musk citing a transgender notification law in California as an impetus for why he wanted to move. We do want to get back to the markets and get back to earnings, because for the first time in a long time, the bar for earnings growth is actually pretty high. Forecasts for the second quarter were lifted to 8.5%, the highest since 2021. Most analysts are expecting 68% of the industry groups to report robust increases as well. Michael Casper joining us right now, equity strategist over at Bloomberg Intelligence. And let's start off with the general expectations for this earnings season, because it seems like the last few quarters we've come in and everyone said the bar was on the floor. So if you missed, you've just missed.
Yeah, the bar is definitely significantly higher this quarter. We're looking at, again, 8.6% EPS growth on 4.4% revenue growth. So the bar definitely higher. Our guidance model suggests we could have about 12% earnings growth, so significantly higher than the earnings bar. But again, it's going to be pretty difficult. 8 of 25 industries still expected for a decline. Tech and communications still leading the earnings gains. So it's a very lumpy earnings season still, and the bar is significantly higher.
Okay, so with that in mind, where are the risks here? How about sector leadership as earnings go?
Yeah, I think some of the risks are that we have a little bit more rotation that we've had over the last week or so. And does that actually get cemented by the fundamentals this earnings season, right? So Mag 7 earnings growth for the next 4 quarters after 2Q, so 3Q through 2Q next year, expected to slow into the mid-teens or so, with the 493 catching up to that. And that, I think, is what investors are trying to front run, and we have to see if that actually gets cemented this earnings season.
Is there any reason, though, where we think that this quarter is going to be different when it comes to that differential that we've seen between the Mag 7, the big cap tech, and the rest of the market? There's a reason why those stocks rallied the way they did. I mean, that was a fundamentally driven rally. The earnings and, more importantly, the top line numbers were there.
Yeah, the earnings expectations have been improving for especially out after 2Q.
Yeah.
A lot of it was to do with that, weaker than expected CPI print, right? So we had disinflation actually.
Yeah.
And we're kind of looking for that to kind of continue and see if it can be cemented this earnings season with fundamentals.
All right, Michael, great. We're going to leave it there. Michael Casper over at Bloomberg Intelligence. I do, Alex, just real quickly want to go back to some other breaking news on Elon Musk. We're now getting another headline crossing the Bloomberg terminal, Alex, that Elon Musk is also going to move the headquarters of X, the platform formerly known as Twitter, also to Austin, Texas. So this would effectively bring at least his 3 major properties, SpaceX, X, and of course Tesla, all into the purview of Texas.
And I like what Ed was saying just before, is that a lot of SpaceX launches are in Texas. So from that perspective, even regardless of whatever laws he doesn't like in California, that makes sense.
And most of the Tesla executives are down there already, as there are a lot of the X folks. So more of just rearranging the chairs for something that he's already done. We'll find you some more details on that, but we want to continue our discussion about this earnings season with Melissa Brown, Managing Director of Applied Research over at SimCorp. And Melissa, we were just talking with Michael Casper of Bloomberg Intelligence. Are we going to get to this stage, this quarter, this earnings cycle, I should say, where we are going to see a little bit more broadening of fundamentals? Or are you more comfortable as an investor kind of sticking with some of those big cap names that have proven their ability to generate cash?
Well, I'm really hoping that we do start to see things broaden out. The market has been so narrow. It's been very hard for anybody trying to beat the market to actually beat the market, because so much of the activity has been concentrated in the Magnificent Seven. And so I think with the prospect of the Fed lowering rates seeming, if not inevitable, at least extremely likely, that could, it's not going to affect second quarter earnings, but it will going forward, I think, start to impact some of the earnings of smaller companies, of other growth type names, and so on.
What do you think one of the narratives that we're going to hear out of a lot of these companies? I feel like the last 2 earnings cycles, it was kind of like if you can articulate an AI strategy, you were going to get a pop in the shares, even if that AI strategy didn't actually accompany any real earnings or revenue growth, but more just the promise of it. Is that story still in play, or are we going to see maybe investors focus on something different?
Well, I guess I'm old enough to remember the back 25 years ago in the internet bubble, when all a company had to do was say, oh, we're developing an internet strategy. And it also didn't matter what that strategy was. And it was never, or for many companies, it was not quite clear what it was. And, potentially not so much for the traditional AI companies, not for the NVIDIAs, but for every other company that is now talking about developing an AI strategy. I think investors are really going to have to sort through those those claims and the impact and what the company is actually doing. Are they really able to build on AI and somehow either improve their revenues or improve their margins or whatever?
Yeah, and also just, monetize it at the end of the day. So you brought up margins, and I wonder, the theme so far, and this is over the last couple earnings season, is top line still struggling, but cost cutting has really helped margins, and that's been the support. Does that stay the support this time?
I think it probably does. I guess the one major difference between the last few earnings seasons is that inflation has come down. So we could potentially see some better top line growth. Perhaps expanding margins as companies have actually implemented the some of the cost cutting and it's really taking effect now.
All right, well, that's a fair point. If inflation does come down, but then PPI was a little stronger, so it's a little bit more murky. Because we've seen expectations not come down into earnings, what do you think the reaction function is going to be of a stock if it beats or if it misses?
I think if it misses, it's really going to be in trouble, particularly, the Magnificent Seven and other, similar types of names, because investors have really placed a lot of their faith in those stocks driving the market. I think the general expectation is that companies are always going to beat by a little. So even if they just report in line with expectations, that may not be great news. It's not necessarily terrible news, but it's not great news. So in order for a company really to have a positive earnings surprise, its earnings are going to have to be significantly better than expected.
All right, Melissa, great stuff. Melissa Brown, Managing Director of Applied Research over at SimCorp, here as we count you down to the closing bells here on this Tuesday afternoon. When we come back, a closer look at some of the big movers on the day, including Match Group. Those shares higher here on news that Starboard Value is taking a stake and plans to push for a sale of the company if it can't turn things around. It's our stock of the hour, and it's up next right here on The Close on Bloomberg. Time now for our stock of the hour. Looking at Match Group, the share is rallying about 7% here on the day on the back of reports that Starboard Value has taken a stake in the company and planning to push for a sale if they can't pull off a turnaround. Abigail Doolittle joining us right now to talk a little bit more about a pretty sprawling company here. They own a lot of properties, but there's been all this talk here about how a younger generation just not as wedded to these apps as maybe the older generation was. So what do we know about what Starboard wants? Because Elliott has a stake, Anson has took a stake. So you have three big hedge funds now have primary stakes in this company, pretty large stakes.
So essentially what they want to do is unlock the value of this company because it's a really strong business. They generate $1 billion in free cash flow every year. They have decent growth, not as much growth as they used to have. It's interesting, the stock had been at its peak during the pandemic, funny enough, because you wouldn't think, but I guess that was how people were meeting at that time.
People had like dates online. It's like a thing. Yeah.
Oh, really?
Yeah.
So that is reflected in the stock. And then I think that people thought that growth was just going to continue, and they weren't able to do it. So Starboard's basically coming in saying that we want you to increase the operating margins to above 40%, clean up the Tinder brand, because that's the one, that was their big growth engine. But apparently Hinge has a better format. So they want Tinder to gain the Hinge format so that Tinder will take off again. But here's the biggest thing. This company has 2.5 times leverage. Their max is 3 times. So at the end of the day, what they're really saying is we want you to take on more leverage, buy back stock.
Take on more leverage.
Well, go up to your maximum leverage level and buy back stock and support the stock. Technically, it's really interesting because if it goes below 27, it's going down. But if it goes above 42, and I think that's the better chance that it's going to go higher. Take this company private is very, very difficult. So there is a possibility they're just trying to create this pop, which they've done. And if they can continue, they could get the stock higher because, frankly, it used to be a growth stock. It's not a growth stock anymore. It's not a GARP stock either.
Yeah.
So they need a new ownership of value owners. If they can find that, I think that this stock may tiptoe higher.
So I covered this stock on radio.
I was just watching that commercial.
I know, I know, me too.
What's going on there?
There's like confetti. And
for Tinder, guess what the age range is for Tinder? Do we know this? Pop quiz. No?
Like 20 to 25? No. Well, you were just saying
25 to?
I was going to say, I actually was saying 20 to 25. Is it shockingly high?
It's 25 to 34.
Oh, okay.
And you can kind of see that in all their different business models. Like it just goes different by age. Here's my silly question with activist investors. Do they all have to agree on the same thing? Like what if they don't?
So it's interesting that you're saying this. I imagine that they probably, at the end of the day, they want to unlock the value. That's why they're making the investment so that their money will go higher. But apparently some analysts are saying that Elliott, they didn't go quite as far as as the analysts had expected Elliott to go. And that now maybe Starboard's going to kind of pick up from here and get a little bit more aggressive in terms of the operating margins, really make some stuff happen with Tinge. Elliott, of course, does have 2 seats on the board. So stay tuned.
All right, Abigail, thanks a lot. Really appreciate that, Abigail Doolittle, joining us there. And we are counting you down to the closing bells. Small caps continue to rally hard. The Russell 2000 still up by about 3.5%, while the S&P hits another record high. If we close here, we're on 38 record closes
Have you heard
for
of
the
Hakuna?
year.
Hakuna, Azar. I'm looking at all the Match Group properties here. I'm lost. Our Time, which is for older people. I don't know what Hakuna is for.
There's something about fish too. Rich Weiss comes up next. This is Bloomberg.
Yeah, we have a promo. Sorry. Welcome back to The Close. Romaine Bostic here alongside Alex Steele. 10 minutes until we get to those bells. A similar story that we've had the last 5 days with big outperformance in small caps and cyclicals relative to the large cap universe.
Yep, you got small caps outperforming, tech in particular. It does feel like it's a sell the Mag 7 buy small caps. I was talking to Scott Rubin over at Goldman Sachs a little bit about that earlier. So that is part of it, but you wonder if small caps can continue this kind of gain, then what happens? Also to point out, Charles Schwab getting hit enormously hard, the worst performer on the S&P, that really dragging down any sort of upside for that index.
Yeah, really interesting story out of Schwab, and maybe something we can revisit over the next few days and weeks here as that company really tries to reposition itself for, I guess, what is going to be a more realistic future. We do want to continue on the market themes of the day with Rich Weiss, CIO for multi-asset strategies at American Century Investments, with about 9 minutes until we get to the closing bell, setting up for Rich what is going to probably be yet another record high for the major indices, at least for the S&P and for the Dow. And a lot of questions right now about whether this rally has run its course or maybe whether it's time to actually get on the train. Are you chasing this rally, Rich?
No, we are not FOMO, okay, fear of missing out. We are not jumping on the train. It's never comfortable fighting the tape, right, being the contrarian. But what's that old saying? Sometimes the light at the end of the tunnel is just a train coming at you. We have an economy which is clearly decelerating. I don't think that's open to debate. The manufacturing and housing sector is still weak. And the consumer, although we had some good numbers today, the consumer is stretched, right, with delinquencies and late payments. So it's really, at this point, we see this as the last legs of the bull market, with it broadening out to small cap and other sectors. And if you want to see higher stock prices, it's not just about the Fed cutting. It's about earnings, all right? 8 to 10% earnings growth already expected, discounted in the market. So if you want to see stock prices go higher, we're going to need more cowbell.
Great, Rich. So when we talk about that more cowbell, give me a sense, though, here of what you would feel comfortable investing in, given what you just said here about your perception of conditions.
Well, if we're talking about equities, obviously we'd be in the diversification camp. So we're fans of the spread to financials, other value sectors, smaller cap, basically all of those sectors and size elements that have not fared well, non-U.S. equities included. But more importantly, with the marginal dollar, we'd stay in fixed income, relatively shorter duration, higher credit quality. That's a bird in hand, right? Now, we know the Fed's going to be cutting rates eventually, but you could still get 5-6% in very high quality securities. And, relative to what may or may not happen throughout the rest of the year, economically, politically, we see that as the prudent way to go.
Rich, if you like value and you like small caps, though, don't we need to get past this economic soft patch if that's what we're in for those trades to work?
Yes, or maybe yes and no. Lower interest rates clearly are a boon for small cap stocks and arguably value stocks in particular, as we all know, financials, REITs, which, this last week or so have really taken off. I think that's the start of that trade. Mm-hmm. But, I'd argue we're towards the end of this cycle. Money's now flowing into early cycle sectors like financials, maybe a little early. But again, diversification's the name of the game. If you've ridden the Mag 7 and you're concentrated to any degree, much less 40, 50% of your portfolio, now's a great time to spread that across other sectors.
Rich, what do you think people are selling to buy small caps and value, for example? You mentioned Mag 7. Okay, take some off and do that. Do you think money's moving out of money market funds? Like, where else is the flow going?
Yeah, exactly out. So clearly, the Mag 7, there's some profits being taken there, and money market funds. There has been a lot of cash on the proverbial sideline because you've been getting 5.5% with zero risk, essentially. So those are the two main places I suspect. I haven't seen the latest flows, but certainly over the last week or so, that's where it's coming from.
Talk about the election, Rich. Do you ignore it? Do you trade around it? What are you doing?
Boy, we do not invest our clients' money based on what we think is going to happen with the election. The relationship between the political and the economic cycle is not clear. And it's just a high-risk bet. To use the parlance of horse racing, it's known as a parlay bet, like the trifecta. You not only have to be right on picking the winner of the election, you also have to be right on two other independent bets, which is, will the winner be able to affect the policies you think they are, and that's, of course, dependent more on Congress than it is the president. And then third, and not least, has the market already discounted that information? So again, you have to be right on three separate bets in order to make money on an election trade. So we stay away from it, prefer to position based on the economic fundamentals, okay? Not who's going to be in the White House or whether Congress is locked, et cetera.
Well, when it comes to those economic fundamentals, particularly on a global basis, Rich, I mean, the U.S. has kind of stood out for pretty obvious reasons, but there's been a lot of discussions about that American exceptionalism, whether it's waning. We've already gotten a lot of anecdotal evidence of investors, global investors, I should say, trying to look for other places to earn a return other than the U.S. Are you one of those folks?
Yes, very much so. Again, along with the diversification theme, the U.S. has had an exceptional stock market, okay? And we've outperformed virtually any other developed and many of the emerging markets over the last, 10 years, just as stocks have outperformed bonds by an exceptional amount over the last 10 years. So we're looking to diversify. And in fact, if you look at not only our own forecasts, but the consensus forecasts of the major economists, U.S. growth decelerating this year. We've far outstripped, in terms of real economic growth, the major developed nations, but they're already beginning to climb. They have been, in many cases, reducing interest rates. So they are arguably on the upswing while we're in the downswing. Expect that gap to close between the U.S. and the major developed nations. Ergo, we'd expect to see stronger, surprises in earnings overseas relative to what we got here.
All right, Rich, going to have to leave it there. Always great stuff. Rich Weiss, wealth of experience in the world of finance, now CIO for multi-asset strategies at American Century Investments. As we count you down to the closing bells here, Alex, just about 2.5 minutes to go here. And the outperformance, 3.5% gain on the Russell 2000. You overlay that with the NASDAQ that's basically flat on the day.
Yeah, it's actually kind of amazing. Also, the Mag 7 down 0.4%. Here's a question, though. If small caps sell off, where we reach oversold levels and you're going to have a reversal, does money go back into big tech?
It's a big question, and I think we're going to get that answer over the next couple of weeks as those big tech names, including Netflix on Thursday, start to report earnings. If they're still generating the cash, why not?
Maybe not. Yeah, but then you have to monetize. It's many questions. Too many questions.
Too many questions that we're going to try to answer. Stick with us. This is Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic and Alex Steele here to help take you through the closing bell. It's a global simulcast starting now. Scarlet Fu joining us in the TV studio. Carol Massar and Tim Stenovic in the radio booth as we bring together our audiences across all of our platforms, including our partnership with YouTube. Carol Massar, another phenomenal day if you're a small or mid-cap stock, particularly relative to what's happening with the larger cap brethren.
Yeah, the outperformance, right, that we're finally seeing in small caps. We've been talking about them, I feel like, forever, guys. We're seeing investors move into it. Once again, though, I'm going to highlight also the financial sector, because you're looking at the KBW Bank Index up almost 5% in the last 2 days alone, and that compares with about not even quite a 1% gain in the S&P 500.
Yeah, the Russell up 3.4% right now, up about 11.5% so far this year, which is underperforming the major indices. Well, underperforming the S&P 500 and the NASDAQ. I got to tell you, I feel bad for anyone who has to do decliners today because the rally is so broad-based.
Meaning you?
Meaning me. Yeah.
No, whatever. You got Schwab. You're fine.
I got Schwab. What else do I have?
You've got lots of talking points tied to Schwab. It's so interesting you point out the gain in the Russell 2000 for this year, because much of that has come in the past couple of days. Since Thursday, the June CPI report came out, the Russell 2000 has gained 10%, Mag 7 have fallen almost 4%.
Yep, Russell 2000 beating the NASDAQ 100 by almost 11 percentage points just in the last 4 sessions, not counting today. Haven't seen that since 2011.
The cross-asset moves with yield slightly lower here. Bitcoin higher on the day. The VIX a slight tick higher as well. Nevertheless, you are looking at record highs, at least for 2 of the major indices here on this Tuesday afternoon. The Dow Jones Industrial Average looking to finish out the day up by more than 700 points, or about 1.8%. A run closer back to that 41,000 level, 40,958 and change as we wait for the numbers to settle. That is a record high. 566.7 on the S&P 500, up 36 points from where it was yesterday. Also a record high. The NASDAQ Composite up about 36 points, or 0.2% here on the day. And the Russell 2000, which is still about 200 points away from claiming its record high, getting ever so closer to that 5 straight days of gains, including a 3.5% gain here on today.
All right, for all you technicians out there, maybe no surprise, though, to see that if you look at the RSI on the Russell 2000, you are seeing it overbought at this time, so piercing above that level. Back to the big caps, though. Scarlett, you're going to get into the major industry groups on the S&P, but most names, in the S&P actually gaining ground today.
Yeah, absolutely. And you see the weak links of the S&P 500 in the IMAP here. They are the 2 biggest sectors within the index. You have tech and communication services, each down by at least 0.4%. But your broad advancers are industrials, materials, and consumer discretionary, all gaining at least 1.5%. And it's worth noting, too, that for the Russell 2000, all 11 industry groups are higher by at least 1.5%.
All right, guys, let's get to some of the individual gainers. Match Group, certainly among the top gainers in the S&P 500 today, finishing the day with about a gain of about 7.5%. This is after Starboard Value built a stake in the company, becoming the 3rd activist investor to do so, to take a stake in the group, in the company specifically. Starboard has about a 6.6% position in Match, and the investor plans to push for a sale of the company. So tracking that.
Which Match Group app do you use the most, Carol?
Depends on the day. You know, it depends kind of in my mood. There's just so many. Moving right along. Bank of America up 5.3% in today's session, rallying, moving to the highest in more than 2 years. We heard from Brian Moynihan sitting down with David Weston, talking about the consumer, talking about the lending environment. Company did report trade and investment banking results that topped analyst estimates, did give a forecast for NII, net interest income, its biggest source of revenue, that also exceeded expectations. Another banking name, State Street, up about 7.3%, finishing at its highs of the session, up after beating revenue and net interest income expectations as well for the second quarter, even amid some high expectations. So that's an outperformer. And just one more earnings name I want to throw in there. United Health up about 6.5%. This is after the company reported second quarter adjusted profits that topped estimates, even as the firm saw medical costs that were higher than Wall Street expected. Can I say I like Tinder? No, I don't like Tinder. Okay, moving right on.
You don't like Tinder? No, Carol, you can't say that.
I don't say that.
You like the veggie one. There's like veggie friends or something. That's the new one. Not veggie. Something like that.
Yeah, exactly.
All right, moving right along. I think,
Swipe right for
Scarlett,
broccoli,
I think you were the one
left
who
for
recalled that
cauliflower.
I do have Schwab today, finishing the day down 10%. Shares suffering their biggest intraday drop, going all the way back to last year's regional bank crisis. That was back in mid-March. This after Schwab warned that it will have to shrink itself in order to protect profits. So going forward, Schwab is planning to rely more on off-balance sheet arrangements to house customers' deposit. This is according to Walt Bettinger, the company's CEO. By relying on partners like Toronto Dominion Bank, deals would allow Schwab to more efficiently use capital, he said. Investors not cheering the results after that earnings call this morning. Shares down more than 10%. Also, shares of DJT rallied yesterday, but they fell today. Fell 9%. This after the owner of Truth Social registered 38 million shares that could be sold as part of a pact with Yorkville Advisors. The registration relates to a pact unveiled on July 3rd that would potentially dilute existing investors to sell $2.5 billion in common stock. As I mentioned, shares rallying double digits yesterday. And ticker PGR, Progressive, also in the red today. Shares fell after reaching the highest intraday level on record. Shares down more than 3% today. This after the insurance company reported second quarter net premiums earned that came in ahead of estimates. So good earnings, but shares fell after reaching the highest intraday record level on record, Alex.
See, you got it. You did stuff. There were definitely some
Slim
decliners,
pickings.
thanks to Charles Schwab. All right, going to the bond market here. You saw buying across the curve, so that steepener trade taking a bit of a break today. 2-year yields down by about 3 basis points. 10-year yield down by about 6 basis points. So we'll see. We'll see what happens tomorrow after we've seen that steepener over the last 4 days. Taking a break today, TBD.
All right, guys, you know how we got the retail sales number coming in stronger than expected. Having said that, we talked with our Chris Condon of the Bloomberg economic team and basically said, you know, all right, it's one data point, but what we are seeing is a lot more metrics that are showing some consumer weakness. And there's a great story on the Bloomberg about car repossessions, that they're up 23% in the first half of 2024 compared with last year. And you're seeing signs of increased stress when it comes to consumers, and higher interest rates certainly playing into this, Tim.
Okay, so let's talk numbers here and let's talk rates. The average interest rate for a new car is currently 7.3%. For a used car, it's 11.5%. That's according to data from Edmunds. So, Romaine, that means that bills are up to $739 for a new car and $549 for a used car on average.
And we should point out, we spent a lot of last year talking about that increase in those payments. And of course, now we're starting to see the data of how it comes back to bite some folks. We are getting some earnings crossing the wire. This on the trucking company, J.B. Hunt, a big miss on the bottom line. Second quarter earnings per share coming in at $1.32. The street was looking for $1.48. On revenue side, also a miss, $2.93 billion in sales. The street was looking for roughly $3.3 billion in sales. You can see the shares, guys, down about 3% in after-hours trading. Yeah, we knew that the rates were going to be a problem, right? But it was sort of when that trough comes and when they sort of work its way out and how the recovery winds up looking like. It does not look like that recovery coming right now. Those shares down now 4.5%.
And by the way, this is now the 7th straight quarter that EPS has fallen. So it's been a pretty steady decline here. And the big question is, at what point have we reached the bottom? According to Lee Klaskow, spot rates may have rebounded off the bottom, but the supply really needs to tighten for the rates for truckloads to really move higher in a sustainable way.
Yeah, so stock here down almost 3% in the aftermarket. Keep in mind, it's down about 12% here in 2024. So again, some concerns here. Again, second quarter EPS miss, and you look at revenue also coming in light here, Romaine.
I do want to go back to the consumer here. There were some headlines just a while ago on Five Below, the discount retailer, basically saying that its CEO, who's been there for quite some time, since at least 2015, has decided to step aside, Joel Anderson, to pursue other things. The interim CEO put in place Kenneth Bull, suggesting that this, of course, was not a planned transition. Those shares down, but they also pointed out in releasing earnings here that they're seeing significant weakness as well, which could be interesting, too, against the backdrop of what you guys were just talking about with the car repossession story.
Yeah, shares down 5% as we speak. They fell as much as 5.6% post-market as the CEO stepped down. Tom Velios, the co-founder and chairman, appointed interim executive. Five Below names Kenneth Bull as interim CEO.
You know, we talk about the repossessions of cars and how you miss 3 months of car payments, your car gets seized. It's a bit of a contrast to 2009, where people were talking about how cars are the last thing that people are willing to miss payments on, because that is what they need for their livelihood, right? In order to get your job, you need to hold on to your car. Your house, not as much.
Does anyone remember that video that went viral where it was like a car dealership and they were going around asking people what their payments were? And
they're all like over $1,000.
Yeah, it was crazy. It was like $1,000 a month for whatever, souped up, Dodge Charger they had. And I don't know, maybe that was a harbinger that maybe,
But they were like proud of it.
Yes, I know, exactly. So it's just kind of a different mindset. And again, at some point, I guess that comes back to bite you if you can't get out from under it.
Yeah, actually, absolutely. But I think it was interesting what you said, Scarlett, about kind of it's the last thing you're going to let go, right? Because it probably gets you to work and takes care of everything else. So it's a big deal. All right, guys.
You can't rely on the subway?
Not every city has a subway.
Exactly.
We in Seattle last week, we were able to take the light rail, the monorail,
and the bus.
That was cool. Your video was really cool on that, actually.
It was fun.
Does that thing go anywhere? I went on it once, and I was just like...
The monorail, it goes between two spots, and it's from the early 1960s.
All right.
I'm
sorry, I've got to get back to the dating apps. Some of us have some things to do. All right, guys.
Just swipe right on Bloomberg.
I thought he was going to take the monorail to Shelbyville.
All right, that is our cross-platform radio, TV, YouTube, Bloomberg Originals, folks. Beyond the Bell, closing bell.
Does Mr. Masser know about this?
Shh. Okay. We'll see you same time, same place tomorrow.
All right, stick with us. Earnings season now getting into full swing, a full analysis up ahead of what we learned out of the trucking company, J.B. Hunt. This is The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. 5 straight days now, Scarlett, we've seen meaningful outperformance of small caps relative to large caps here on what is another record-setting day, at least for the Dow and the S&P 500. 0.6% gain on the S&P. But look at that differential with the Russell 2000, a 3.5% gain. 5th straight day that we've seen the Russell outperform the S&P and outperform the NASDAQ, suggesting that, yes, that rotation, that repositioning into more cyclical sectors, it might actually be real. You see that reflected in consumer durables down at the bottom of your screen on the back of retail sales. You see that reflected in home builders, and you even saw that reflected today, Scarlett, in a lot of the financial stocks, but not every financial stock participated in the rally.
No. A big outlier here today was Schwab. Charles Schwab falling more than 10% on the day. That's the biggest drop since the regional banking crisis in March of 2023. The investing giant warning that it will have to shrink its bank operations in order to protect profits. So big question marks as to what that will look like going forward. We're also keeping an eye on Match Group, which is up 7.5%. This is after Starboard Value built a stake of more than 6.6% in the online dating app and said it plans to push for a sale of the company by March, if Match fails to turn around its operations. Worth mentioning here that Starboard is the third activist investor to take a stake in Match, which has seen the number of paying customers really drop off. Now, that brings us to spending and our top story this hour, which is to don't write off the consumer just yet. Today's retail sales data show that spending unexpectedly held up in June versus economists' projections for a decline. And excluding the impact of a cyber attack on auto dealers, sales actually rose the most in 3 months, which does provide a tailwind into this year's Amazon Prime Day. Sales in the first 7 hours of the event up 12% over last year. But the nuance lies in how people are spending. For instance, Swiss watch sales slumping in a sign that demand for high-end goods remains fairly uneven. Romaine?
All right, well, when we talk about the consumer, you have to talk about, the trucks that bring a lot of those goods to those store shelves. Shares of J.B. Hunt right now lower this after reporting earnings. EPS down year over year and missing estimates. Revenue down year over year and missing estimates. Some concern here that volume has completely dropped. Bloomberg Intelligence Senior Logistics Analyst Lee Klaskow joining us right now for more analysis. And Lee, what exactly is ailing this company right now? Is this just a story of just not enough goods being moved?
Yeah, I think volume expectations were maybe got a little ahead of themselves this quarter. The miss appears to be mostly on the volume side versus the pricing side. Pricing's not great, but it's mostly in line from our perspective. The good news for J.B. Hunt and the broader trucking industry is that, rates appear to have bottomed. We expect spot rates to kind of bounce along where we are today and start moving higher as the year goes on, which should bode well for contractual rates, which most trucking companies are involved in. Hunt weakness also was impacted by the brokerage business. The volumes in terms of were much lower than expectations. And the volume from that perspective is probably being driven by the company deciding to be a little more selective in terms of what freight it's taking on to try to improve the profitability of that division, which still lost money during the quarter. I think it was around $13 million. Which was slightly more than expectation. So, volumes, again, probably the biggest reason for the miss today at J.B. Hunt.
When you say that volumes is probably the biggest reason, it sounds like it's an industry story rather than a J.B. Hunt story. What can J.B. Hunt do on its end to minimize some of these macro headwinds?
Yeah, I think what all trucking companies are trying to do in J.B. Hunt is not alone, is just making the investments that make sense. And right now, the investments that make sense is anything that's going to improve productivity, and a lot of those are technology-driven investments. So on their brokerage business, so pretty much each person can do more loads per broker. That's a big metric that we kind of look for when we're looking at transportation companies. But when we look at brokers, and again, J.B. Hunt is a major freight broker, and that's one of the reasons, in our perspective, why they missed. The outlook for the broker business has been improving. We do a survey every 6 months with TruckStop, one of our data partners here at Bloomberg, and the outlook has improved dramatically, where the overwhelming majority believe that volume are going to either increase or remain flat over the next 3 to 6 months.
I am curious about one line item here, and this is on net capital expenditures, a big drop on a year-over-year basis, basically down about half of where it was in 2023. Should that be interpreted by investors as a good thing or a bad thing?
I think it's what they're doing is they're being disciplined with what they're doing with capital. Obviously, if you don't have as many volumes as you might have expected, or your volumes are off significantly from the year before, you need less equipment, you need less trucks, and trucks are expensive, and you might need less trailing equipment. So, that's probably the thing that's been driving that. Also, J.B. Hunt was kind of an industry leader with their investments in technology. They might have had some outside investments in technology over the last couple of years. They're probably reining those in these more challenging markets.
All right, great stuff, Lee. Always appreciate you taking time for us. Lee Klasko over at Bloomberg Intelligence. Hopping on real quickly here to talk about J.B. Hunt. Those shares lower, dragging some of its peers down as well, including XPO, which is down about 1% or 2% in after-hours trading. Yeah,
I wonder how much of the cost picture when it comes to these trucking companies still has to do with them hiring drivers and not being able to find the right talent. Remember, that was a story for so long after the pandemic, during and after.
Yeah, it is. And I do wonder, and maybe as we get deeper in this earnings season, we can talk to some of those executives and find out whether that's a thing. But this ties directly into the consumer spending story, right? Yeah. And if you're looking for, I hate to use this phrase, but a canary in the coal mine here, maybe you do look at what's in the back of these trucks or maybe what's not in the back of those trucks.
Very well said.
All right, coming up here, we are going to talk a little bit more about the consumer as well and the repo man. Repossessions of cars skyrocketing this year as high interest rates and inflation really putting the squeeze on household budgets. Details on that after the break. This is The Close on Bloomberg.
High interest rates and tight consumer budgets are making some monthly bills simply unaffordable. So far this year, car repossessions are up 14% compared to the first half of 2019. This is according to data from Cox Automotive. Claire Ballantyne, Bloomberg News personal finance reporter, joins us now. So take us through some of the data that we do have here. We're not comparing it to last year or 2020, for instance. We're bringing it back to the pre-pandemic era.
Yeah, and that's because the pandemic caused a lot of weird things to happen with the car industry. So basically, during the pandemic, a lot of lenders were more lenient. You also saw consumers have these stimulus checks and lower interest rates. So basically what happened is repossessions were, at a moderate level, then they dipped, and now they're climbing back up. And that really reflects the worsening status of the consumer and people kind of struggling to afford their monthly bills.
Is there a reason, though, why the car owners themselves, the car companies themselves, or the finance companies, I should say, are being more aggressive than what they were? Why aren't they as forgiving as they were maybe 2 or 3 years ago?
A lot of that was due to just the pandemic in general, and a lot of leniency. We had leniency in student loans and another kind of debt. So basically that was sort of an anomaly, and now we're back to normal. We're back to, repossessors coming after cars when people have missed about 3 months worth of payments.
I also wonder how much of it is tied to adjacent costs to owning a car. Like car insurance has gone up quite a bit. And Allstate CEO Tom Wilson has told Barron's that you'll see auto insurance prices continue to stay higher. They were up 16% in 2022, up 16% in 2023, and up 2.4% this year. But that's just the race that got approved. It does take, he says, up to a year and a half for everything to ripple through.
Absolutely. There's insurance costs. It's not just your car payment. It's all these other things that go into owning a car. And not just that, it's the higher prices for everything. We know inflation is cooling, but it's still caused tight budgets. And so people are trying to balance all of their expenses, and car payments are kind of
parking costs, car wash costs.
But what about this notion, though, too? I mean, we talk about this idea that, if you are struggling to pay your bills, the car is one of the last things that you give up on, because a lot of people in this country are reliant. If you don't have a car, you're not going to go to work or go to school or other things here. Have we reached sort of a tipping point where things are that bad, where people just have no choice but to sort of allow these repos?
They're definitely getting worse. I mean, I think that is sort of what people have to weigh when they're deciding what bills to pay. In some cases, it's deciding between your house bill, your student loan bill, your auto bill. We do see that auto bills are pretty high on people's list of priorities, but it really depends on the person, I think. But yes, we do know that in so many parts of the country, you have to have a car to get to work. If you lose your car, you lose your job. So it's a huge priority.
So you're Bloomberg's personal finance reporter. What metric would you look to next to kind of follow along with car repossessions going up?
A big thing that I look at is some data from Fitch Ratings, and they do a great job of tracking the number of people that are at least 60 days behind on payments, especially with those subprime borrowers. Those are the people that are most at risk of having their cars repossessed. We saw that reach a record high in February. It's dipped slightly because of some seasonal factors, but I'm going to be watching that to see if it goes back up again.
All right, Bloomberg's Claire Ballantyne, thank you so much, our Bloomberg personal finance reporter. Now, speaking of repossessions, but for an entirely different reason, let's get to the first subject of today's top three, where we name drop the people driving some of the day's most talked about stories. And first up is Senator Bob Menendez. Jurors found the New Jersey Democrat guilty of, so many things: bribery, extortion, acting as a foreign agent of Egypt. His corruption trial remained focused on the FBI seizure of 13 gold bars, almost $500,000 in cash, and a Mercedes-Benz at his home. He was convicted on all 16 counts.
Not just in his home. It was stuffed in his coat pockets and other things like that. First of all, thank you for this reminder that he's actually still in office, because for some reason I thought he had left like a long time ago, and I forgot that he's been fighting this all along. It'll be interesting. I don't know what the legal process is now. Can he appeal this and maybe extend this saga out for a little bit longer? But I saw Chuck Schumer was already out, effectively the Senate leader, basically saying that Bob Menendez should resign.
Yeah, and of course, he has a track record here, right? Yeah. Because there was a 2018 corruption trial that ended up in a hung jury. Yeah. So nothing came out of that, and he continued to serve in the Senate. A
lot of trials going on for this guy. Someone else I've been keeping an eye on, actually two folks I've been keeping an eye on, Mark Andreessen and Ben Horowitz, of course, of the firm Andreessen Horowitz. And, the pair have reportedly told their employees that they plan to make large donations to PAC supporting presidential candidate Donald Trump. Now, this shouldn't be too much of a surprise. Both of them have leaned pretty heavily to the right for quite some time. But what is interesting is how many folks we are seeing out of this sort of Silicon Valley ecosystem that have basically made it very clear they plan to back Trump. David Sachs, of course, a big VC, has been on board for some time. Elon Musk, I think it was just yesterday or last night, said he would devote some more than $100 million in 3 different chunks to some of these PACs as well.
Yeah, I think he said like $45 million per month. Andreessen, for his part, did say that they are nonpartisan one-issue voters, and their issue here is the crypto industry. Yes. So they're pro-crypto, and they believe that a Trump White House would be pro-crypto. Okay. So that's their argument from their defense. Yes. Wonderful. All right. Finally, our last top 3 person, or top 4 at this point, is Bill Ackman. Yeah. The billionaire hedge fund manager has been telling potential investors in his new fund that his notoriety on social media will help the fund trade at a premium valuation. So he has...
Wait. So that's why he's been so vocal? So he doesn't really care about these issues? He's just trying to boost the value of his company?
He says he's going to continue to talk about many issues on social media, but this is a reason why the fund will gather a lot of assets. Because he's very outspoken on social media. He's going to use the platform to talk up his investment strategies, and that's going to allow him to scale.
Okay, good for him.
You wouldn't invest with him? Not saying a word. Romaine is very difficult to.
God bless that crazy kid there. All right, we got a lot more coming up here on the program, Scarlett. We're going to talk a little bit about the consumer, about Amazon Prime Day. Have you started your Prime shopping?
I'm not into this.
Yeah, me either.
I don't get into it.
Yeah, I think it's all a ruse. But nevertheless, we're going to talk about it anyway. Because today actually marked the first day that Amazon sold its first product ever.
Oh.
Here's a question for you before we go to break. What was Amazon's revenue in its first year of business?
Double digits, triple digits.
The answer when we come back after the break. This is Bloomberg. All right, let's open up the history books and take a look at the history of one single book, Fluid Concepts and Creative Analogies. Stick with me, this is going somewhere. It's a dense 1995 book by the AI pioneer Douglas Hofstadter on the mechanisms of computer modeling. But it would gain notoriety for its distinction of being the first ever item ever sold to the public on Amazon.com. It was on this day, July 16, 1995, when a former hedge fund executive named Jeff Bezos, who had traded in his life on Wall Street for an entrepreneurial dream out there in Seattle, pushed the button that made Amazon.com live to the public, selling its first ever item. The person who bought that book, his name was John Wainwright, who was one of the key developers of object-based computer languages. Now, the legend goes that an Amazon employee who was friends with Wainwright sent him the invitation to Amazon's beta site. Wainwright says that he actually ordered the book on April 3rd of that year, though Amazon dates the sale and delivery to July 16th, when the website officially opened. Now, the sale of Fluid Concepts was otherwise unremarkable for a company that year would gross only $500,000 in revenue in its first year of business. But a year later, things had changed. Amazon reported revenue of almost $16 million, and by 1997 was trading as a public company, boasting more than 2.5 million book titles available for purchase. By 1998, the company began selling music, and in 99, expanded to a wider array of products, including toys, home goods, and consumer electronics, going from Earth's biggest bookstore to the everything store that helped propel it to more than $500 billion in annual revenue today. It was a rocket ship launched 29 years ago by an obscure book on computer models. Copies of that 500-page book, I should say, which Wainwright says he only paid $27.95 for, are still available for sale. Today, the latest edition will cost you roughly $15 for the paperback, $16 for the Kindle version. And as for Wainwright himself, his contribution to Amazon's history earned him a name on one of the buildings on the company's corporate campus at 535 Terry Avenue North, out there in Seattle, Washington.
Great story. It sounds like that first item sold was a friends and family kind of thing. So I don't know if we can count that because, I can then start my own company and sell you something, and would that count, Romaine?
That's how it works.
All right, well, maybe I'll get up to $500,000 in sales my first year, too. All right, let's stay with Amazon because their early data is in for Amazon Prime Day, and it did not disappoint. Sales were up 13% in the first 6 hours of the online shopping bonanza as compared to last year. The data coming in from Momentum Commerce, which manages Amazon sales on behalf of 50 brands, including Crocs and Lego. For more now, we are joined by Beryl Tomay. She is Amazon VP of Transportation, which means she's responsible for Amazon's last mile delivery technology and businesses. Beryl, thank you so much for joining us. Obviously, a lot to discuss here when it comes to Amazon Prime Day, but from where you sit as the Vice President of Transportation, what is new for customers on Prime Day this year when it comes to their actually getting delivery of their items?
Thanks for having me. It is Prime Day. It is our 10th Prime Day, and we're excited. We're ready to go. We're off to a great start. And one area that we've been really investing in is offering vast selection this Prime Day. We have millions of deals available, dropping as often as every 5 minutes through select periods. We have more deals from small businesses than ever before through any Prime Day. So we're excited to invest in that small business community. And of course, we continue to invest in convenience. We've been investing quite a bit on speed on the transportation side. Last year, given the investments we made, we hit some new records of 4 billion items in the US delivered same day or next day speed. We're off to a great start this year as well. In the first 3 months of this year, we've delivered over 2 billion items at same day or next day speeds.
So today's day one of Amazon Prime Day. How do things change for day two? Are the offerings, do they get changed up a little bit? What happens if you sell out of certain things that are a really great deal?
We have millions of deals available. We think customers are going to really enjoy getting a head start on their back to school shopping. We have deals up to 50% off, sometimes even more for products in that category. But we have over 35 product categories with deals dropping frequently. So those include apparel, electronics, kitchen, home, beauty. We also have some new brands this year, like Clinique and Allbirds. So we think there's going to be something for everyone.
Talk to us about, I mean, you're there, of course, in a warehouse there. We can see the folks working behind you, Beryl. Talk about the technology behind this, because there's been a lot of talk about Amazon's capabilities when it comes to not just the logistics, but the technology that goes into that logistics. What improvements have you made over the last 10 years since Prime Day launched?
We have a history of decades of technology and AI investments. For example, we introduced robotics into our operation over a decade ago. And today, we have over 750,000 robots that work collaboratively with our employees to help them with tasks like lifting heavy objects, reducing walking distances, and more. Of course, this in turn creates a safer and more ergonomic experience, and also helps move items faster through the building, which is great for our customers.
One of the interesting things about your job description, Beryl, you're not only responsible for getting things to us that last mile, proverbially, so to speak, but I was also told, aren't you also kind of in charge of overseeing things like returns and stuff? Because, you know, I'll just speak for a friend here. You know, there are some folks out there who order a lot of things and then they realize they need to exchange, or so a few of those things as well. How do you deal with that deluge of returns and exchanges, particularly when you're not dealing with always with the physical item itself?
We want to make it really easy for customers to be able to return something because they change their mind or they want to get something different. So we have great returns policies, and we encourage our customers to check out those policies on our site as well.
Beryl, how much of a correlation do you see between the enthusiasm for Prime Day and what you might expect later on in the year during the holiday shopping season? Because the idea for so many people, according to my colleagues, is that you buy a lot of the holiday shopping gifts now in July when it's heavily discounted, so that you don't have to participate in that rush at the end of the year.
We see customers responding really well year-round based on the types of things that they're looking for. For example, we've made significant investments in our everyday essentials products, where we see customers coming back year-round. These are items like household products, personal items, as well as groceries. So we think about all of these independently, and overall want to provide low prices, vast selection. I mentioned small businesses. Over 60% of products sold in our store are from independent sellers.
Yeah.
And of course, the convenience piece, like speed.
All right, Beryl, wish you the best of luck. Want to catch up with you after this, see how things went. Beryl Tomay, Amazon's vice president in charge of getting you all those packages here as Prime Day kicks off. And we are focused here on the consumer as folks rush to Amazon to take advantage of some of those deals. But it might be a vastly different story at the other end of the economic spectrum. Jharonne Martis joining us right now over at LSEG to talk a little bit more about the health of the consumer. All right, I'm good for that. Well, let's just stick with Amazon for 1 second before we get to luxury here, because I was going through the deals. Everyone puts out these long lists of the best deals, and I don't know, it was just kind of like nothing I really needed. Is this still, does this still have resonance for the consumer, Prime Day?
It actually, 100% it does, and it's very evident by the numbers. Even our forecast is forecasting a 5% growth in online retail revenue for the Prime quarterly month. And, you know, investors are not betting against Amazon. On the contrary, we're seeing that buy side are actually find Amazon very, very attractive. This is because it's trading at high volumes, it's very profitable, and it has positive price momentum. So in general, what we're seeing is that, yes, consumers are gravitating towards Amazon because they are being pickier when they open up their wallet. They're being very precise with their time, you know, management about waiting for those deals when they purchase something right now. But also we're seeing that not only Amazon, but Walmart, and all the other companies that are participating in the Prime Week Madness, they're doing so because they're seeing the value of attracting new customers.
Yeah, we've seen Temu and a couple others now
Yes.
start to offer discounts as well here. I mean, obviously they're trying to appeal to much more price-conscious people. What about the other end of the spectrum? For those folks that have a lot more disposable income, aren't as sensitive to prices, are they still spending on items, particularly luxury items?
So in general, we're seeing that the consumer is trading down. It was very evident in the last earnings season when Walmart saw a spike at 21% in membership revenue, which is humongous, by the way. And our forecast is still forecasting that it will continue to grow for the year. And this is mainly because it's attracting a lot of those high-end, upper middle class consumers that are also feeling the pinch for inflation and want an everyday discount.
Yeah.
And of course, it's not just Walmart or Amazon. You've got Costco as well, which also appeals to a certain higher end customer. Based on what you've learned, do people tend to have multiple memberships? Do they, go all in on all of these different vendors, or are they kind of trading between these different ones?
So the American consumer is all about instant gratification and good customer service. Costco has the highest retention rate at 93%.
Do you know Scarlett's an executive? Were you an executive member?
I'm an executive member of Costco, yes.
Well, there you go. So you know this. You're loyal to your customers are loyal to you, to Costco. Anyways, and then Walmart, obviously, with their membership being half of what, not even half, it's $45 right now. So yeah, about 1/3 of what Amazon is definitely luring in more shoppers at the moment. It has the cheapest membership rate compared to those three. So Costco has the highest retention rate. Amazon is definitely making the highest amount of dollar value for membership services, subscriptions. But however, in terms of online growth, Walmart is the one that is expected to see the strongest, 15% e-commerce growth, followed by Amazon 5%, followed by Target 3%. So 15%, we're talking about double-digit growth. Everybody else is single digits.
Yeah, that's pretty impressive. I mean, Amazon started this whole thing with the Prime Day, and now, suddenly mid-July is a big shopping event period before it wasn't, right? I mean, most people didn't even do back-to-school shopping until August or so. How has the invention of Prime Day, this manufacturing of this holiday, changed our consumption habits?
So in general, the consumer has changed their habits recently. So in the last earnings season, one thing that all retailers were in agreement with is that the consumer's only opening up their wallet right now when they see a promotional event. So if they're eyeing an item, they can see that the consumer's eyeing the item online. However, they will wait until whatever discount they can get their hands on in order to make that purchase. So a lot of consumers have been waiting for this week of madness. Online comparison still happens online, and everybody's trying to take a piece of it. It comes down to whether you want the product now, whether you're willing to forego the product quality and buy it somewhere cheaper, or if you want a cheaper membership.
I mean, that's great for the consumer, but as you say all that, I'm thinking about these companies and their bottom lines here, and I'm wondering, is this going to be healthy for them? I mean, when we get to retail earnings in about 6 weeks or so, are we going to start to see a lot of weird misses because they discounted too much? No,
on the contrary. So in a collaboration with Centric Market Intelligence, LSEG discovered that the only thing that's different this time around is a lot more merchandise is on sale. So this is the highest month. July is the highest month of the entire year where we've seen more merchandise on sale, but the average discount again is below that 40% number we've talked about before. Remember?
That's my sweet spot.
Exactly. So we're at 36% right now this week.
I don't get out of bed for anything under 42.
Exactly. Oh, there you go. You've raised the bar.
Are there more men's stuff on? Because I feel like the last time we had you on, you were talking about all these sales, and it was all like women's clothing or family items, but it wasn't like men's suits.
They weren't
men's
speaking
shows.
to you.
No, I mean
No, in fact, what's mostly on sale right now is back to school. Believe it or not, most merchandise on sale. This average discount is still not as high as before.
Yeah, and the Facebook college parents groups, they all talk about, I've got this list on Amazon waiting for Prime Day. I'm gonna hit buy for all of these items like the mattress topper and the under the bed shelving, all of that.
Still, I have to say, out of all the discounters, the one that offers the highest back to school sale is Target. They have the highest average discount and also the highest discount penetration, meaning most amount of back to school merchandise on sale.
All right, Jharonne Martis, thank you so much, Director of Consumer Research at the London Stock Exchange Group. I guess we'll see if it all pans out the way that they expect when the earnings reports roll around in about 6 weeks' time. In the meantime, let's take a look at how stocks closed on the day, and lots of green arrows here, whether you're looking at the S&P 500 or the Russell 2000. Certainly, the Russell 2000 is the eye popper. They're up 3.5%. That rotation is really, really coming into effect.
And this is what everyone wanted, right? Now, whether it's sustained or not, it remains to be seen. But I mean, 5 days. We haven't had this type of outperformance. I mean, you have to really go back to that brief period we had in late March.
Yeah, the Russell 2000 beating the NASDAQ 100 by almost 12 percentage points over the past 4 sessions. Yields also coming down as well, the 10-year at 4.155%. This is the close on Bloomberg. For Republicans, all the action is taking place in Milwaukee. So let's get the latest on the Republican National Convention from Kelly Lyons, Balance of Power co-host. And of course, we've been doing special editions of Balance of Power because of the RNC. Kelly, in terms of what's on tap tonight, we know that President Trump has announced his vice presidential pick, that is J.D. Vance. Who's on tap for tonight, and what will that tell us about this campaign?
Well, we have a long list of speakers on this second night of the convention, Scarlett. I would point out that the theme of this second night is Make America Safe Again. So we could probably expect these speakers to focus a lot on crime in America, as well as the issue of border security, something that Republicans talk a lot about. Some of the Republicans that will be doing so tonight are pretty notable, including former presidential candidate herself, former South Carolina Governor and UN Ambassador Nikki Haley, who wasn't originally invited to this convention. Donald Trump extended that invitation over this past weekend after the assassination attempt and the shooting that threatened his life. As he says, he is now focusing this convention much more on a message of unity. So Nikki Haley will have a chance to speak to a delegation that, frankly, may not welcome her, as we consider the delegates assembled here, the majority of which, of course, did not vote for her in the Republican primary, though ahead of this convention, she pledged all 97 of her delegates should vote for Donald Trump. It'll be interesting to see the tone she strikes, whether she encourages her voters to vote for Trump in November.
Well, I am curious with her there. I was looking through the list of folks coming tonight, and it is a lot of, I guess, if you can say, some of President Trump's former foes, if you will be there, including little Marco Rubio. I think he called Ron DeSantis Little Ron as well, or Meatball Ron, or whatever there. Give us a sense here. But I'm wondering, too, against the backdrop. I mean, looking at Mitch McConnell come down to the floor yesterday and get booed, even though, I mean, I felt like half those people in the room should be thanking him because they have a Supreme Court they wouldn't have had without Mitch McConnell here. Do people really know where their bread is buttered here?
Well, it's an excellent question. It'll be interesting to see if Nikki Haley gets the same reception as Mitch McConnell got. If it comes into a kind of Ted Cruz moment in 2016, when instead of endorsing Trump, he told everyone to vote their conscience and did not have a great reception with that remark. So tonally, that is going to be interesting. But you're exactly right, Romaine, to think about the idea that each of these former oppositions to Donald Trump, whether it be Ron DeSantis, who will be speaking right after Nikki Haley, Marco Rubio, who until yesterday thought he was still in contention to be Donald Trump's vice president, how they have to come into Trump's corner, essentially. And it'll be interesting, too, as we look forward to 2028, which, of course, is a million light years away in political terms. The selection of J.D. Vance as the vice presidential nominee is not only going to be something that is probably hard for Marco Rubio to swallow, but the likes of Nikki Haley and Ron DeSantis, who were unsuccessful in this election cycle. If J.D. Vance turns out to be vice president, that puts him almost automatically in a front-runner position in the cycle in 2028, should he so choose. So it makes their odds of one day getting the Oval Office even harder. So there's so many dynamics to consider here, even as, of course, we're not yet underway on night 2, Romaine.
All right, Kayleigh, I'll let you guys get back to work. Of course, you can catch Kayleigh and her co-host Joe Matthew at the top of the hour on Balance of Power, live from the Milwaukee, the Republican National Convention out there in Milwaukee, Wisconsin. And it is kind of interesting, too, to see this maybe potentially changing up the guard, because when we talk about the VP picks that were speculated about, it was kind of, I guess, the old guard, you know, the Rubios and the Nikki Haley's and stuff. And the idea he would go for a rising star, only 39 years old, J.D. Vance, I think is kind of telling. And, of course, being from Ohio certainly doesn't help a big swing state.
Yeah, well, he's definitely thinking of his legacy, right? And this is kind of the next generation to bring MAGA to the younger generation. So Donald Trump thinking ahead. I just found out that Ivanka Trump will be at the RNC tomorrow when her father speaks. And of course, she's been kind of absent from a lot of the activities this time around. She was very active. She was a big presence the first time around when Trump ran for president in 2016.
Yeah, we haven't.
Less so this time around.
Yeah, we haven't seen his family members, her, Jared, or even Melania, not necessarily as present, physically present on the campaign trail as we saw in the last election cycle. So it'll be interesting to see whether that theme of unity does stick here. And of course, we'll have full coverage on Bloomberg over the course of that convention. In the meantime, when we come back after the break, right here on The Close, we're going to set you up for some of the big market moving events over the next 24 hours. This is Bloomberg. Looks like it could be busy over the next 24 hours. Here are some of the market-moving events that investors will have their eye on. We're going to start overseas, Scarlett, with some economic data out of the United Kingdom.
Yeah, you've got CPI and PPI, and then following that, the King's speech, not Colin Firth, but Charles Windsor, will be speaking. He's going to deliver the speech as part of the state opening of Parliament under the new government that's now Labour-led.
That was a great movie. Remember that?
It was really
good.
good.
Yeah. It won an Oscar, right, or something like that? All right. I don't know if Charles there is going to win an Oscar, but we'll be tuning in for that. We come back here to the U.S., the former colony here, and we get housing starts 8:30 a.m. tomorrow.
Yeah, this will be key, too, because we know that demand is starting to pick up with the expectation that rates will come down. So we'll see how much momentum that does have. We also have industrial production as well at 9:15 a.m.
Yeah, I'm interested in that as well because we have seen continued softness in that manufacturing and factory sector here. So it'll be interesting to see what happens. We also get the Fed Beige Book, which very backwards looking, but still usually some decent anecdotal evidence about how folks are feeling on the ground. Yep. And we get more Fed speak tomorrow.
More Fed speak before the Fed goes into media blackout mode on Saturday, and they can't talk because the FOMC meeting is coming up next week. And I know you don't watch a whole lot of TV, but I do, and the primetime Emmy nominations will be coming out tomorrow as well. Cheryl Lee Ralph of Abbott Elementary and Tony Hale of Arrested Development. Yeah. They're going to announce the nominations in L.A.
So who's going to lead the nomination? Like, what's the big show? Shogun?
Yeah.
Okay.
I think Shogun. And the Bear will probably do really well again.
As soon as the show's over, I have to Google what Shogun.
Oh my God.
But I know. I'm a lost cause. Did we get nominated for Emmy this year?
Move on.
All right, we get earnings out tomorrow. Maybe that will get us an Emmy before the bell. We get some of the regional banks, including U.S. Bancorp and Citizens Financial.
Yeah, we also get more companies in the healthcare space. We heard some from the health insurance space, but now Johnson & Johnson will also be reporting. And after the close, United Airlines.
Discover and Alcoa also on tap after the bell. We'll be here for your full earnings coverage right here on The Close. But stick around. All your politics coverage coming up next on Balance of Power right here on Bloomberg.